And it's a big rate cut to about 21.5%. That is the current monetary policy rate we are talking about. That is a significant drop by the Bank of Ghana, some 350 basis points. What really informed the central bank to arrive at this rate? That will be what we'll be discussing and analyzing here on Beyond the Numbers. Caleb Ziblim, as always, is here to help me, analyze this on the smart wall. And today we have a special guest, Alfred Appiah, popularly known on X as Call Me Alfredo. He will also join us. He's a data scientist and a political, analyst. Policy analyst. He will also join us here on Beyond the Numbers. So let's get to the smart wall. And as always, Caleb, this is an impressive number. Policy rate around 21.5%, and we were analyzing on marketplace that 350 basis points is a wild cut. Definitely BoG may have certain things under their sleeve. They may be so confident about what is happening in the local space, looking at the international outlook, and possibly that's why they've dropped the rate to this significant level. You have been looking at the summary of economic and financial data, basically the Bible that results in some of these decisions. This is an important number. First of all, help us understand, in terms of our viewers, when we say policy rate, what does it really mean? And this cut that we are seeing, how significant is it?
So the policy rate is the rate at which the central bank lends to the commercial banks. When the commercial banks give money to the central bank, the BoG pays them some interest. And if it's very high, it means that commercial banks give all their money to the Bank of Ghana.
Yeah.
There's less liquidity for private investors, households, and all of that. So once your policy rate is low, it means that banks have to go elsewhere to go and find money. And then they pass that low interest rate on to consumers. That's how it should be theoretically.
Yeah.
So if once banks pass the low interest rates onto their consumers, then we enjoy lower interest rates on our loans, and then houses, businesses can go and take cheaper loans, and that's used to spur up private sector investment and all of that. So this is a very important number. And then this is important because of where we are coming from.
Yeah.
Earlier this year was around 28%, and the BoG maintained it for some time, and then they cut the first one by 300 basis points, or 3%.
I think there was a hike before a cut, right?
Then when the new government came, they hiked it up, and then they held it steady for some time, and then they cut it from 28 to about 25. Now we are seeing from 25 to 21.5, which is massive. So in just a few months, or the past two MPC meetings, the policy rate has reduced by almost 7%, which is significant. I don't think any other central bank in the world has cut these tips in the past few months.
We have a point. We are at a point where our policy rates are around 21.5%, Treasury bill rates around 3%. It tells you the kind of direction the monetary, policy guys are going, and those who are in charge of our fiscals also want to go. Just recently, we heard the finance minister who said that, we are only borrowing to, invest in strategic areas like road infrastructure and all of that. We've seen the big push, which will definitely get about 13.9 billion Ghana cedis. But some of these distortions, right? The important question is, how do we even come to a convergence when you see the Bank of Ghana going on this tangent and the fiscal side, where it is usually handled by the finance minister, going on this side of the equation?
Like you rightly said, the policy rates is from the monetary side, that's the Bank of Ghana, and the treasury bills are from the fiscal authorities, which is your finance ministry or the government. And the BoG is independent of the government.
Yeah.
So what the BoG does is not controlled by what the government is doing. So if the T-bill rates are low at 10.3, this theoretically should not influence the BoG's decision when they are dealing with their policy.
But definitely there will be some compulsion there, right?
Exactly, because once you have this mismatch, it means that the banks would prefer to put their investments in the policy with the central bank, because they're earning significantly more over there as compared to your T-bill rates. And if you look at the past few weeks, the government has been struggling to meet T-bill targets because there are more attractive automobiles on the markets where the banks can take advantage of. But then also, it's important because before we got to this 10.3, there was a equilibrium between the policy rates and the 91-day T-bills. So if you could, from last year to early this year, then the policy rate and the T-bill rates were almost the same, around 28%, 24%, it was almost the same. So this new administration came with their different fiscal policies, and then they drove down the T-bill rates significantly. And then I remember when we started to do the analysis earlier this year, I was even thinking that this cannot be sustained.
Yeah.
Because the T-bill rate felt it was artificial. I felt like the government was pushing it down intentionally to reduce borrowing costs and all of that. And usually when these things happen, the markets will just hold back their funds.
They'll react.
So they see that you start increasing rates again, and then they come back to the market. But then the finance minister has been very disciplined in dealing with the T-bill rate, because for the past few months, even though we don't meet the targets, the government is barely increasing the treasury bill rate.
Well, it simply means that if you go to the T-bill market, for instance, supply is there, but government has decided to drop its demand. And if you definitely drop your demand, what it's going to mean is that it will create some of this mismatch that we are seeing. But remember, we analyzed this and we said that, well, it could be that government is having a strategy in terms of what it wants to do in the short-term market, and even, a strategy in the long-term market where it is even hoping to introduce or bring back the issuance of bonds, exactly. Right? Yeah. And many have said that that's the reason why you're seeing T-bills still around 10.30%, because government believes that now it is risky to hold short-term assets or bills. Why don't we come back to the market, which the IMF has said that even if you come back, make sure your first issuance is not more than 2 years. Yeah. And government is hoping to come back. Definitely, with such, with the coming on board of the DDEP, and now people lost trust in, long-term, bills and all of that. If government is coming into the market, you expect it to quote a rate higher than the T-bill rate. But the question is, how long can government continue to keep the T-bill rate around 10.3% when policy rate is currently around 21.5%?
Well, so you can see from the BoG that they are willing to reduce their rates. But then they are not going to go at it very fast. They want to take their time, make sure inflation is in check. And this is important because the policy rates and inflation is almost correlated.
Yeah.
Once inflation is very high, so what the policy rate does is that it reduces the amount of money in the system, it reduces liquidity. Because once it's very high, BoG can take the funds from the commercial bank, because commercial banks will leave their money with the BoG. Once the money is with the BoG, the commercial banks cannot lend money to the public. And then that reduces money in the system and it controls inflation. So once inflation is high, your policy rates should also be high. But once inflation is coming down, and like you said earlier, inflation is at 21%, inflation is at 11.5, the policy rate is at 21.5. This is too high. So the bank seems to be reducing the policy rates gradually. And then this 350 basis points that we've seen is the largest we've seen so far. But then that's how far the bank is willing to go. And then if you look at some of the language from the MPC members, they see further cuts going on because of the way the external side is very favorable at the moment. So hopefully by next year, the policy rates, inflation, and the 91-day T-bill rates should almost be the same. And then once we have that, and we know in the media budget, the finance minister said by September, they're going to start steps to come back into the local bond market. When that happens, you should see that the local bond markets will have higher rates than the T-bill rates, because governments will want to attract funds. So usually it shouldn't be too high, but then it should be somewhere between the policy rates and your 91-day treasury.
So definitely, if government comes into the market to issue bonds, you don't expect it to be less than the T-bill rate.
Exactly,
to be higher.
Because
you also wouldn't expect it to be more than
the
policy rate. So it will be sandwiched between the policy rate and the 91-day T-bill rate. But definitely, nobody knows whether it will be around maybe the inflation rate. But when we had Marketplace and we were discussing this behind the scenes, one thing that came out was that if you look at, the differentials, right, where we simply see what is going on with the cedi, which we'll come to very soon. But many have said that there could be that mismatch where a lot of people have said, well, if you look at the current, exchange rate situation, it's not the true reflection of the economy. Many are also making the point that if you look at the inflation rate, that doesn't also show you the true situation of the economy. So once you are beginning to correct inflation, Bank of Ghana would also, exchange rate or the dollar rate, Bank of Ghana will also have to use some corrective measures like quantitative easing, like, cutting the monetary policy rate to also reflect true inflation. Because we all want inflation to go down, but when it really, really goes down, the question is, does it really reflect the true picture of the economy? I understand that Alfred is on now. And Alfred, you're welcome to Beyond the Numbers. You have been listening in, and in fact, there's no data in this country that you have not looked at before. But we are asking a very important question, or a simple question. If you look at what you have on our smart wall, where there is that significant difference between the policy rate and the current 91-day Treasury bill rate. The question we are asking is, what really informed the Bank of Ghana to have that sort of gravitas to go ahead and cut monetary policy rate by some 350 basis points? Do you belong to the school of thought that says that, well, there is that balance between what is happening in the local space and also in the international space, where people have said that, well, international market or the international space looks very stable at the moment. If you have the Fed cutting its rate, then it's time for the Bank of Ghana to also, tag along.
Kofi, thanks for having me, and I hope you can hear me
loud and clear.
I agree that I think I expected that there was going to be a cut. I think I was surprised by the magnitude of the cut, and that is in part because of some of the downside risks that I expected, right? I know you had mentioned about the CD to dollar, the dollar to CD rate, and all of that. That's something that we have to keep an eye on. But also, we know what's coming in terms of utility tariffs, right? And we know that the pass-through effect of that is going to impact on inflation. The last time we did the major tariff review, we increased electricity by 28%, right? And so those, in as much as those housing-related costs that are in our CPI basket is about 10%, we know that even when utilities increase, there's also that pass-through on food and all of the other parts that are very significant in our CPI basket, right? So I think that on that score, and considering that the city has been under a lot of pressure, and we also know that in periods of depreciation, the pass-through is much faster than in when we have appreciation, as we had in Q2. I expected that the central bank would have extra a bit of restraint and maybe do like a 200 basis point drop in the rate compared to the 350 basis points. So on that score, I thought it was surprising. I think the other thing is also when you look at a lot of the central banks are also holding, right? So I mean, the Fed cut, the Canadian bank also cut a little bit, but they were very cautious, right? I think was the word. I think the other thing though is when we look at, with the U.S. and Canada, for example, the growth was slower, right? So obviously if growth is slower, you're trying to stimulate tenders, so you want to cut so that consumers and businesses can borrow at a cheaper rate to sort of stimulate the economic growth. Okay. But in that case, our growth has actually been very resilient. So on that score, I don't think we really justify it that way. So I think just thinking of what is coming in terms of the external factors, especially the pressure on the CD, we also know what's happening with the gold board. We know that I think when you look at the gold exports in the first half of the year compared to so far in the second half of the year, there seems to have been a little bit of a drop, like based on at least the data that they've communicated publicly. So I think on those score, and we know there's a forex inflows from the gold board, right? So on that score, I think that maybe the CB would have been a little more restrained in terms of the magnitude of the cut.
Great. So I mean, you were surprised about the magnitude, and just like we were discussing on Markets Place, that well, maybe 200 basis points, just like Alfred is saying, but once you have the Fed cutting their rate, it gives you some sort of, impetus to possibly come in the market and add more. So maybe that's why you are seeing that 350 basis points. But the point is that if you look at the data, for instance, if you look at how the policy rate has actually, the trend so far since, 2019, this is one of the steepest drops we've seen in a very, very long time. And you can see it here where you see how, the steepness, very, very steep in terms of the drop, and I'm sure Alfred can see it when he's also analyzed it. But let's look at some of the factors that definitely during the Monetary Policy Committee meetings they will consider in terms of, let's start from the domestic space, and definitely start with inflation, where, as you can see, inflation has been on the downward trajectory. But one thing you see is that when inflation is rising, policy rate rises faster. You see more cuts, right? But when inflation is falling, the Bank of Ghana is a bit cautious in terms of cutting rates, or almost all central banks. That's why maybe Alfred said that he was expecting that they would have exercised some bit of restraint. But they have seen this curve and possibly are confident that if you look at the local space and looking at this key indicator, which is falling, that will give them sort of, in terms of respite. But look at it in terms of the real numbers, inflation in the last, possibly in the last 10 months, from November 2024 to August 2025. Do you think that this justifies that 350 basis point cut we are currently seeing? Look at it, very, very, steep in terms of even the inflation drop by itself.
Well, if you look at the inflation drop, our inflation is also partly driven by the value of the currency.
So the exchange rates pass through effect, right?
So when they see the appreciation sharply, our inflation rates also, that's where you can see the inflation coming down a bit. But then if you listen to the Director of Research from the Bank of Ghana, they said they are confident that they are going to beat the BoG's target by the end of the year.
Yeah.
The plus or minus 8. Also, they expect it to go down to about 10% and even single digits before the end of the year. So, since from the BoG's point of view, once you have your inflation in check...
That forward guidance is very, very important, right?
Exactly. And once you have your inflation in check, which is one of the main indicators the BoG using the policy rates to fight, once that's in check and you have your external conditions also looking very favorable, I think I understand why the BoG took such a drastic step, because once the Fed cut rates 2 days ago or 3 days ago, that drove the price of the dollar down. So the dollar index has come down a bit. And then once that's also happening, investors are trying to maximize returns. So they all flock to gold. And then our gold prices are all-time highs, above $3,600 per ounce. So even though we've seen some reduction in gold, the forex from the gold board, the BoG is still confident that the higher gold price on the markets can sustain, the economy in the near future. So that might be why the BoG decided to take such a drastic step. Because if you look at the external side, it's looking very favorable. The domestic side as well, the fiscal authority seems to have, been very disciplined so far. And then the inflation side is also looking good. So even though, as you can see, food inflation is still above, the normal inflation rate, that's something that needs to be tackled, because, and that has its own problems. Transportation costs, post-harvest loss, so many things with the food inflation. So once that is tackled, I think the BoG is a much stronger.
One thing that surprised me when we were looking at this data was when I saw that we had already reached single digits when it comes to non-food inflation, right? Single digit, but food inflation and the headline figure still above, still in the double digits aspect. But, if you look at the inflation on month-on-month levels, right, possibly you will see why the Bank of Ghana is very confident, because you can see very, very steep, even in deflation zone where it was negative. You compare, let's say, August to July in terms of inflation. That in itself is a very, important confidence. Now, we're all talking about the exchange rate situation, and this is always not a good graph to look at, because just like we were talking about, inflation, Caleb, just look at the last aspect of this graph, or the last part of this graph, where you see that stratospheric rise in terms of the exchange rate. Do you think, and I'll come to Alfred very soon, just looking at that curve, it looks like, an anchor, right? But BoG saw this and still decided to cut rate by 350 basis points. Does that mean that maybe, we've always been seeing a lifeline for the cedi in the last quarter? Is the BoG lacing it to come into the market again heavily, possibly in the last quarter?
But we were talking about this when we saw the rapid depreciation of the cedi in the past weeks. And we were speculating that it's likely because the BoG has stopped intervening too much. And the president confirmed that the BoG has indeed stopped intervening too much. So this is one of the main reasons why we can see the uptick. But then the BoG is confident because gold prices are so high, so the inflows are coming. And also that according to the BoG, they see that most of the imports that happen in the later part of the year, that's September, October, took place earlier. And that put pressure on the cedi, which resulted in the rapid depreciation we saw. So from the BoG's point of view, they say that the inflows are still solid. Cocoa is still solid, gold is still solid. The only problem is our oil inflows. Because oil is dropping. Last year we did above 2 billion. This year we are still below 2 billion for the first half. 9 months.
That's not good news for the big push, right?
Exactly, because the revenue for the big push comes from oil, from our oil revenue. So once that's reducing, together with your stronger currency, you are going to receive less funding for the big push. So that's what we discussed the last time on Beyond the Numbers.
Well, Alfred, let me bring you at this, but I'm sure you are seeing the the graph there. Don't you think that last aspect we are seeing, which we've actually highlighted in red, shouldn't that have been sort of like a caution to the Bank of Ghana, possibly to exercise some bit of restraint, just like you put it in your first submission?
I think that always is a risk, right? That's always going to be a risk, and especially because we know that once there's depreciation, like, you know, people quickly change their prices, right? Like, and so that's where that transmission is really key. But I think that the BoG, of course, also is listening to businesses, right, and hearing things around the fact that interest rates are so high. And then, you know, the Bank of Ghana has to do something about that. So they're sort of trying to balance out the different factors, right? So I can understand that. Like I said, I think for sure by default I would have expected a cut. I just didn't think it would be that high, but I could understand. I could understand it. I think it's also important that we also look at the transmission of those cuts, and you know how the interest rate is actually getting transmitted through the market, right? Because, for example, like when we look at the Ghana reference rate, at least it's dropped by about 10 points. Like, how much is that impacting lending rate? I don't think it's proportionate, right? One of the other things also is we look at private sector credit. So, for example, between April and July, you will see that in real terms, private sector credit was actually in a negative territory again, right? And that was something that was a big issue around the economic crisis, obviously with elevated credit risk and all of that. So I think, in as much, I think the plan is BoG wants to make sure that, you know, lending is relatively cheaper, but then I think it's also like, to what extent is that reflecting for businesses, so that businesses and households can borrow at cheaper cost.
Well, I mean, there was an important point Alfred made, and that's about the private sector. We said on Marketplace that, well, there's a 24-hour economy supposed to be the main flagship program of this government, and that is private sector led. Private sector coming in, we need capital. So you need private sector to actually afford capital, you know, on a more cheaper side, right? And possibly that's the reason why BoG is following through with this big rate cut, and maybe we'll see that in the average lending rates and all of that. But one thing that's giving the BoG a lot of confidence is the fact that if you look at our export, value, significantly rise, and compare, if you look at the first 8 months of every year from 2019 to 2025, you can actually see that what is happening this year is possibly an outlier. Yeah. And that in itself gives BoG some bit of insulation against external shocks. How significant is this?
Significant because if for the first half of the year, for the first 8 months of the year, your export is around $17 billion. And gold alone is giving you $11.2 billion. And we know now, because of the new policy around gold board, majority of gold exports, the forex comes to the BoG.
Yeah.
The BoG has the forex in their reserves. So this is what's giving the BoG enough confidence that, okay, no, we can see this through. But if you look at the reserves also, the reserves reduced a bit by about 300 million of...
relatively, it's still very high. But the only one that is taking this out of competition possibly is what happened in 2021.
Yeah. So even though our reserve reduced a bit, it's still significant because our external debt also reduced by $100 million.
Yeah.
So that could possibly be one of the reasons why our reserve reduced a bit. And then, as we hear from the president, the BoG has taken a step back, and they prefer that policy where the mining proceeds go directly to the central bank. They are now with the commercial bank. So the BoG is expected to have less footprints in the market. So seeing that the forex is going to keep coming in from gold, and projections are that gold will stay above $3,600, even $4,000 probably by next year. This is what's giving the BoG enough confidence. Another problem is that gold board is being partly financed by Galamsey. That's a problem. And then the gold board say they are working on traceability systems. And we know that once that takes into effect, gold being exported by gold board is going to reduce. That's going to affect how much forex the BoG is going to collect, and eventually how much they can support the markets with.
Alfred, maybe you have the last bite because we are wrapping up. Just look at what we have on the smart wall, which definitely gives you import versus export, where currently we have a very wide gap between the two. Do you think that this was, this actually gave the BoG that confidence to say that, well, we can do a 300 basis point because almost everything is in the right trajectory? If you look at import, the order has risen to 11.8%, billion US dollars. Export outlook is about 17.9 billion, and gold, if you look at the reserve position, also improved. Export of gold is around 10.7 and all of that. Do you think that what we are seeing in terms of this very gap that we have on the smart wall was one of the reasons why the BoG was very confident that they could do 350 basis points? You have the last minutes.
I think so. Of course, I think the exports definitely give some confidence, right? But I think, and I think you also think of the outlook. I think, when you think of what's happening in the U.S., part of what is driving gold prices is what's happening in the U.S., right? And so if on the basis of that, I don't think the U.S. presidency is changing anytime soon, right? And so if people are starting to project out, they start to know that, gold is going to be stable. But I think that Caleb made a very good point about what's going to happen if we because we know that Galamsey gold is in what gold world is high, right? And so so that's where we have that dilemma, right? Where is that trade-off, like environmental benefit versus economic benefits and all of that? But I mean, you can't really have an economy without a proper environment, right? So those are going to be the points that has to be balanced out. But as long as we want to sacrifice the environment, I'm sure the gold exports are going to be higher, and we're going to keep seeing these numbers. But I think it's something that we have to just keep an eye on, for sure.
Well, Alfred, thank you very much for making time to join us here on Beyond the Numbers. My name is Kofi Agyei, and always I did this with Caleb Ziblim. And Winston Tackie is away today. You saw him on the marketplace, but he'll be back next week. And you saw that big rate cut, but we've explained to you possibly why the Bank of Ghana had that confidence to do 350 basis points. See you same time next week. This is JoyNews, independent, fearless, and credible.